Welcome to Trading Capital's exclusive analysis. Have we finally reached the economic tipping point in the economy? Are we finally getting some signals from the bond market that are telling us the equity markets are pricing in a bit of downside volatility and potentially a macroeconomic slowdown? Now, before all of the macro bears jump out and call for an epic crash, we have to really take things slowly and kind of week by week during this next phase of the market. And that being said, this data can absolutely change from week to week. You get revised prints to the downside, to the upside, but obviously on the back of Friday, we saw an epic down move in the yield market. Two-year yield closing down 7% on the session. That is a massive, massive move to the downside. It has been a while since we've seen such crazy volatility in the interest rate market. Just to put that into perspective, look at the downside move. Practically in about a month of trading, you've eradicated all of the choppy consolidation in one fell swoop. This downside candle came on the back of a lower than expected non-farm payrolls print, obviously showing a little bit of potential weakness in the US economy, and therefore you're seeing a massive decline in the equity markets as well as the bond market. We could be potentially entering something called a bull steepening phase. What does that mean? That is a term you're likely going to hear over the coming weeks across the finance community, online videos. But a bull steepening is when you have the short-term yields, which is this two-year yield, falling much larger than the long end of the yield. So obviously taking a look, this two-year yield was down 7% on the session. When you look at the US 10-year yield, although this is a pretty nasty candle to the downside, it was only down 3.79% on the session. So what does that mean? When you have a divergence between the short end of the curve and the long end of the curve, investors could be potentially pricing in an economic global slowdown, aka the R word that no one likes to use, a recession. Central banks are expected to cut rates in the near term, which is what we've seen on the CME Fed watch tool. The probabilities have drastically swung in favor of basically a rate cut in the September meeting. We're looking at an 80% chance of a rate cut in that next September meeting. So we'll have to see if that wants to play out. Now, looking at that yield curve differential and spread, if you simply take the US 10-year yield minus the US 2-year yield, what are you going to get? You're going to get a huge difference in spread. Look at the pump that we got on Friday between the 10 and the 2-year. A 27% jump in the spread differential. Right now, you're still sitting at a basis of 53 bips. So you're still stuck in this consolidation range, but you are trying to stair step your way higher in this overall 10 and 2-year spread. I've been watching this for quite a long time. This is a very, very long-term signal. It's hard to trade off of on a day-to-day basis. I just want to make myself clear. But this is a long-term signal that you can use to position yourself on the right side of the market. Typically, we were trading in an inversion for the longest time in history. Again, it's been a while since I've touched base on this, but your previous inversions were from a period of 2006 to until the late 2007, mid 2007, until you broke out of it. Obviously, we all know what preceded after that was your GFC crisis. Then you look to your dot-com era, your 2000 period, and you started breaking out of it late 2000, early 2001. Obviously, what preceded was the dot-com crash. So the inversion of the yield curve is an area where investors are pricing in excess inflationary periods. That's what we obviously saw. And now we're slowly potentially starting to get a grip on that inflation. And maybe, just maybe, in the next 6 to 12 months, we're going to see more deflationary forces. But the trend is when you start to break out of this yield curve inversion and really start to widen that spread between the 10 and the 2, that typically marks a very bearish signal for the next 6 to 12 months. Not saying stocks can't rally, can't find a bid, but you just need to be mindful that typically the S&P 500 does go through a correction. I've overlaid the S&P 500 on the chart here, guys. What we're going to observe on the S&P 500 is a couple things. Going back to your 2008 period, when you started breaking out and this spread differential started to explode higher, aka interest rate policy was being cut by the Fed and long-term rates were holding up much better, this differential spread started to explode. What happened in the pink here, the S&P 500? S&P 500 saw a pretty sharp decline as this spread started to widen. Similar scenario in the dot-com area. As the spread started to blow out and widen, two-year yield falling, aka interest rate policy cuts by the Federal Reserve, you had the S&P falling pretty sharply. Similar price action in 88, 89. What happened? The spread started to widen. What happened? The S&P started falling. So the question is this time different? The infamous words in the stock market. We will certainly find out over the next 6 to 12 months, but you have to be on top of your macro right now. And yes, like I said, it's not a day-to-day signal. This is a month-to-month really signal that is playing out. But obviously we see how hyperbolic these markets can be and how quickly the S&P can come off of the highs just in one fell swoop. So definitely be paying attention to your labor market data, the unemployment, the initial job loss claims. Some of the inflation data is probably not going to be as important now as we switch into that labor market regime mode where that's probably going to be the talk of the town. If we look at what happened to the equity markets, I mean, we saw nasty declines across the S&P 500 here. That was a filthy two-bar surge to the downside on the S&P 500. IWM small caps have been absolutely even worse to the downside, but it just shows you how fast these markets can react to the incoming data. And maybe this is just the start. We really have to watch and see what happens over the next 4 to 8 weeks with the employment market. Do we get weaker demand in the US? The US has been a powerhouse up until late, and we will see if they can negate this trend and keep pushing this market higher. But like I said, that spread differential between that US 10-year yield and the US 2-year yield is going to be a very important metric that you need to be watching, because if we break out of this tight consolidation pattern on the 10 and 2-year spread, things could get real nasty in a very quick fashion. If we just simply look back at that 2-year yield, where is the next support level? We got an epic hard dump on the bond market, sorry, on the yield market, which means investors were buying up bonds. You're seeing assets like TLT breaking out here to the upside. You're seeing assets like UBT, which personally speaking, I have UBT common shares long. That is playing a little bit of the long end of the curve. But nevertheless, if we continue to see the short end of the curve plummet, where is the next support level going to be for this US 2-year yield? Well, we violated this pivot. We could be doing a liquidity sweep. We'll find out come this next week and basically 2 weeks down the road once we get a little bit more of that economic data. But we should look for potentially a retest of this 3.5 to 3.45 zone. That is the lower boundary wedge pattern on the 2-year yield that we've been chopping in for quite a long time. So keep your eye for a little bit more downside in the yield market. It will likely come on the back of worsening economic data in the labor market. So if labor market data starts to deteriorate, expect more downside in the equity markets. Now, if interest rates keep falling sharply, valuations, cost of capital does get cheaper. There could be a little bit of a hoorah bounce in the market. We're in this mixed phase where we're just seeing glimmers of cracks in the labor market. According to the official data, you're seeing some minor cracks. So if that starts to hold up and interest rates stay a little bit lower, stocks can still catch a little bit of a bid, but we are entering this tricky potential macroeconomic tipping point that you need to be watching your high growth investments. And one thing that I have been seeing lately that is kind of, again, swinging this in favor of potentially maybe we are entering a recession in, say, 2026, mid 2026 or sooner. We never know. Data can deteriorate pretty quickly. Watch the value stocks, your consumer staples. XLP has been holding up so firmly at these highs. XLU has been holding so firmly at the highs. Look at pretty much everything getting decimated on Friday. Look at utilities. These are strong companies, earning cash. Kind of something that you always need in your life is utilities. So these value plays, when they start catching bids and high growth stocks starting to sell off and make some near interim tops, that again is a little bit of an intraday market signal that you should be paying attention to. Please give this video a like down below and we'll see you on the charts a little bit later.